talking about AI models and their performance in financial markets. And somebody basically said, I recently told folks that, getting a job at a major hedge fund may not be the thing that you want to go after because these models are going to be able to do it, blah, 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 whatever. And I saw somebody respond to that, and he works at a kind of high frequency type fund. And he was like, listen, the beauty of financial markets is like the best, system wins, right? So like, if that is true, then they're going to take all the profit. I think Silicon Valley just like underestimates how cutthroat competition the hedge funds have been in from a technology standpoint for decades. Mm-hmm. And so it really got me thinking about, maybe that's actually the best place for these models to prove like how effective they can be is, can you put it into the market and win? Right. And if you can do that, like that may be the prize. And there's been rumors that, Superintelligence, I think SSI, the company that the guy started when he left, SSI now reportedly is playing around with their models in the market. And so you're just like, if you really do truly have superintelligence, like that may be a use case.
Again, I think it already happens more than people realize. Mm-hmm. So one of the things about artificial intelligence that I want people to separate, because at the dinner after your event, when I sat and talked with younger people, they wouldn't be considered in any way, shape, or fashion quant people. My son is a sophomore in college. He's been working on a system that I've helped him in terms of the idea. Has no quant. He's not a quant. He's creative. He's an artist. And I think the artistry in just knowing how to use AI is separating from quant. So I do want people to understand that my goal for this year personally with helping people understand how to use AI fits directly into this. I brought up 2 books that I'm going to emphasize many times this year. One is the McCraven book, Make Your Bed, which is you have to start using AI every single day. I'm going to show people different ways to do that. But the second one is the Annie book, Thinking in Bets. Mm-hmm. What AI allows you to do is make better decisions. It also will build things for you, which is kind of what a quant model theoretically would be. But now with the capability of saying, hey, I want to find 10 stocks to invest in. The way that I want you to do this is I want it to meet these technical criteria. I want you to use Yahoo Finance for that. I also want it to be, I want you to go scrape off of Twitter the most trending ideas that people are talking about. Okay. That is very simple to do in Grok. Grok gets you the Twitter side. My son did it with APIs, both through X and through Reddit. And it ends up being a momentum portfolio, but you can put the things to say, I want it to be momentum, but only on a 3-month basis or a 4-month basis. I want it to be stuff that people haven't found yet. So I want to find the new ideas, not the old ideas. And I want you to do your ability to just verbally speak and get used to that allows you to compete with hedge funds. It allows you to find ideas faster. The edge in this, if you use AI, is to find things real time. It's to listen to a podcast, immediately turn it into ideas. The weakness in the hedge fund industry for billion-dollar budgets at this point for technology are the gap between ideas and if you're in a crowded trade. That is like the problem. You want to find something before everyone else does. Mm-hmm. The risk reward changes once you're in something that everyone else is in, particularly where people are so fearful and they're measured on a month-to-month basis. I think for individuals at home, they're not on a month-to-month basis, so they can ride these things. Number 2, if there's a fall, they can be patient, but then jump in again, which is what I heard a lot at the dinner. And I think those are the edges that people are getting from AI, which is not a quant side, but it is not having to manage money relative to some benchmark or month to month where you have these arbitrary things, which I think are going to force you out of things more and more.
There is something happening inside of these labs where the next 6 months is going to look very different than it does today. And we're all the beneficiaries of it.
Yeah. The only thing that needs to happen, which will start earlier in the year when Colossus 2 is completed and we're getting up to the 1 million clusters, I just think people have to recognize that the power and the ability of having the data centers to speed up the capabilities is still kind of what's going on. I'm less worried about there being a power shortage I've spent a lot of time on this. I've written about it. We are going to run up against them. We need a lot of gigawatts for this, but I'm a little bit less worried than I was throughout most of last year. That was a big change for me. I do think it will be a negative for the market at some point this year, that people will worry that we're running out of power, and there'll be complaints. You're already starting to see the states pushing back, but I think there is enough behind the meter technology and creativity that's happening. And I think you're seeing this at MIT, you're seeing this at Stanford, you're seeing it in places where if you listen to more and more of the podcast, this new theme is kind of, it's not just, hey, we need more plumbers and this, we need more engineers who are thinking about the creative part of this, which is really, we're reaching the physics part of kind of where AI goes. And that's why for people that are investing this year, the theme to me is going to be very different than last year. I think value matters a lot when you get into this because you're having a broadening out of people that are benefiting. I think for you and I, as we sit here and talk to people, I think a lot of what we talked about today, which was not planned, it's just inspiring people to use it more, to be less scared about it, both from an investment standpoint, but also from a personal inspiration and feeling better about yourself. If you want to move forward in life, I think you have to build a better relationship with artificial intelligence this year.
How does that impact the asset prices? Right? Okay, we got velocity of money, we got all these things, like companies should be making more profit. Let's just go through them. Stocks, Bitcoin, gold. Like, what are you excited about in 2026? And, maybe not like price prediction, but just like, how do you think these different asset classes are going to perform?
So again, I think bonds are going to be completely uninvestable. If you're trying to outperform inflation, I just don't think bonds have enough, you're not getting enough cushion in there. So you're going into the year where credit spreads are at all-time tights, where 10-year yields are not too far away from where 2-year yields are, where you do have a steepening yield curve, but so far it's just going at a slow pace. Stocks to me are going to see profit margins, but we're also at the acceleration point for me for a lot of businesses that have not participated yet. The adoption phase is going to be massive. And I want to leave this thought into everyone's minds. And I'm sure at some point we'll get into places, specific areas. But when you make a phone call and you sit on hold, or you get shuffled off to 17 different numbers before you actually get, or you're screaming representative or whatever it is, those areas are the places where you want to start putting money into. If those businesses have revenues growing, they are going to start to be using agents more and more every day, which means their profit margins are going to grow. It's not going to be a huge expense to replace people. And so rather than firing, again, this is more about every year where we normally would have hired 2 million people. Like, just go back. If GDP grows 4% in a year, what's the average amount of human beings that we would hire? Well, the number's now headed to zero, which means 2 million people times $50,000 a year on the aggregate. We're talking huge numbers of productivity gains, not including the ones that we can reduce to go through it. So I do think stocks are just going to have another good year. And it's not just in the US, it's globally. I believe this is going to be a broadening out of AI now. It's not just the adopters, it's also the physical side, because we're running into the constraints. In terms of commodities, I think they're going to do well. Not all of them the same, but there's a reason why gold and silver are going higher. Gold got the head start because of central bank purchase, but also because people that doubt the system. And I think we're going to continue to have this AI debate on things. I don't want to talk about the long term at this point, but let's just say I think the commodity side is going to remain durable. I think we will have some worries about natural gas and about copper and silver in terms of running out of supply. Elon Musk brought up silver as, hey, this would be a real problem if we're running out of silver. So I think that's going to be fine. And then when you go outside of it, I do think crypto is going to lead the way this year, because I think it's directly correlated with the agents. And like I wrote last year, I believe Bitcoin has gone through something that needed to happen, and crypto in general, which is when there's an investment situation like AI, where people think they can 10 bag something in a year or 2 years, why would the people that have made billions of dollars in this for the same reason, who don't believe in the ideological side of ETFs and the government being more involved, and the more the government gets more involved and is actually sponsoring it, we want out. I think it makes sense for people to be taking chips off the table. And I think it's held in there extremely well with that going on. And as I put in the next post, once we start to get a breakout, I think crypto will be the best performing asset this year.
If we look at GDP growth, that is probably one of the major inputs in my mind. as to what's going to happen in these asset prices. And so what is your expectation, right? I mean, this AI thing, it can't be a coincidence that we are talking about increases in productivity, increases in efficiency, and GDP is growing. It seems like that is a direct impact, and that is why GDP is over 4% right now.
Yeah, so the GDP over 4%, I think we still have to be careful about a couple things. I think everyone who follows the economy at, say, a very signal level as opposed to including the noise, because the reality is inventory cycles and trade cycles are noise. They go up, they go down. So if you just do final sales, we're consistently right now at 3%. And we've been that way. We just had a quarter that was 3%. The quarter before was 3%. The actual GDP number got up to 4.3. Last quarter was 3 point something. So we are, in terms of, I think, the way that people read in the paper, we're close to 4. But the reality is we're just stone cold growing at a very consistent number. I have two angles on this, and I think this year is a really important one. And I actually think the Elon Musk post is important for people to think about. So I've talked extensively about how GDP, you start with a calculation which is not made for this world. It's just not. The intangible part of the economy, meaning efficiency and productivity, it just doesn't fit in this mindset. For us to have really big GDP the way it's calculated, are we going to have a lot of housing sales? Are we going to have a lot of auto sales? Are we going to, because of demographics, because of things, I don't think we're going to have some huge boom. So it has to come from the intangible side. Now, there's two intangibles. I do believe productivity and efficiency are going to accelerate this year because of what we've talked about, which people have to just accept. Going forward, companies will not be hiring people the way that they did. So let's think about the jobs number. Forget what you think the jobs number should be. The reality is we have created less than 40,000 jobs a month for the last, I guess it's 5 months now. And it's overstated, which means let's assume it's zero. Let's assume there's been no job creation. But that happened in 2 quarters where GDP was basically 4%. So if you're not hiring people, but you're growing, regardless of immigration, regardless of AI, don't get into the thing. Just say there's no hiring going on, which shows up on everything. By definition, that means productivity is expanding. If you're not hiring people and revenues are still growing at 8-9%, profit margins are expanding, that's productivity. And then GDP, which doesn't necessarily capture it, it's going to show it. So I believe without any doubt, we are not going to be seeing job creation the way we had in the past, but we're still going to grow. So that means we are going to see productivity and GDP gains. The other thing is, with stable coins starting to advance and with AI agents plugging in, you're going to see more volumes, which Caitlin Long has talked about. I've written about it multiple times now. I think it's a brilliant commentary by a woman who's brilliant in terms of thinking about the financial system. More volumes because transactions are happening more. There's more efficiency going on.
There's less friction.
Exactly. There's going to be a higher velocity of money. And if there's a higher velocity of money, that leads to more GDP. So I think those two factors are going to come, which is going to make this feel, without it being some hiring boom, it's going to show up in profit margins. It's going to show up in stock prices going up still. But I think those are the two places where GDP is going to be. It's a very weird situation because normally you get more GDP from hiring more people who spend more money, taking more debt. That's not going to be the case.